Learn. DQ Learning. Only on Bloomberg Quint.
Good morning and welcome to Bloomberg Quint, India's first digital live streaming business news service. I'm Neeraj Shah. You're watching Indian Open. Let's go straight to the headlines. China says it'll pull out of all trade talks if the US goes ahead and imposes sanctions on Chinese imports, as Donald Trump had threatened last week. Retail fuel prices continue to fall marginally at that, with petrol getting cheaper for the sixth straight day. Diesel prices also inch lower. A new FI monitoring system begins today, letting foreign investors invest almost real time in Indian stocks. And sugar prices recover from the recent lows, even as the GST part committee decides to wait for the Attorney General's opinion before deciding on a sugar cess. Well, a lot of these stocks will be in focus today. Let's first take a look at the trade setup for the day. The world seems to be a happy place. Doesn't seem to be a sad place. Let me qualify my statement. The US markets ended well. The Asian markets have started off with a fair bit of green, and that's rubbing off on how the SGX Nifty starting off, or likely to start off as well. The SGX Nifty started off, let me put it that way, at about 1/3% higher in the green. And in all probability, we can expect some rub of green on our markets at 9:15 a.m. today as well. What happened last week was interesting though. There was a divergence of almost 2.4% between the Nifty and the Nifty small cap index. The Nifty gained about 0.9% or thereabouts for the week at large. The Nifty small cap index fell about 1.6%, so 1.5%. So divergence about 2.4% between the large caps and the mid caps. The daily volumes were higher than average. Even on the first day of the new series, the daily volumes both on the FNO side and the cash market side were higher than average, but the institutional selling has ebbed a little bit. The last 3 days, both the FI and the DI flows, or buying or selling, has been muted, sub 500 odd crores. So it's not been heavy selling that we seen all through the month of May happening in the last 2 or 3 days. Maybe it's a bit of a pause. Let's wait and watch what happens there. Dealer checks seem to suggest that for now, at least for the week, considering so many events, the Nifty may maintain that range of 10,500 to 10,800. That's the broad band in which the Nifty's moved the whole of last week. Doesn't seem that, at least dealers don't believe that that will be the case. Anything else could be the case. The rupee had an interesting move though. Remember, in Friday's session, closed at almost 5 weeks highs of 67.06. Most people attributed this to the rupee demand for HDFC Bank shares, which has been supporting the currency. Let's wait and watch if that continues. And arguably, what's to be watched, the RBI policy will set the tone for the markets. And we will talk about earnings in a bit, and Darshan will bring up a complete picture of how the season has looked like. But I think what he said yesterday about Manish and their thoughts probably epitomizes what the street's thoughts are as well, that Q4 a bit lackluster than what was the case earlier, or what was anticipated, and thereby cuts in the FY18 EPS earnings for sure, and cut in some estimates for FY19 for almost all the sell-side brokerages. This is just one example. The stocks to watch today, I've just highlighted 2 or 3. There'll be many more, but the 3 that I thought would work would be important ones. Hero MotoCorp, just after market hours, we saw the sales numbers come out for the month gone by, up 11% in May at about 7 lakh units. This is much above what the street was working with. Let's wait and watch if there's a further reaction into Hero MotoCorp. HDFC Bank shares, we'll talk in detail about this, so I don't want to dwell too much upon it, but the trading window for the FIs opens today. Needless to say that there could be some bit of action in HDFC Bank in today's trade. It was anticipated that Friday will see the action. There was a bit of a delay. We're already seeing a big move in HDFC Bank in Thursday's session. There could be some moves in today's trade as well. Let's wait and watch. Yathan will come in a bit later on in first word and dwell upon this for a bit as well. We'll also take stock of what the valuations look like. So that's coming up a bit later on, but HDFC Bank certainly will be a stock in focus. And sugar stocks, from the recent lows that the sugar prices have gone to, there has been at least a 10% odd uptick in sugar prices in India at least. Raw sugar prices across the world too have moved up a bit. Let's see if there's a bit of a trading reaction into these stocks. They haven't really moved northwards, save for the volatile Balrampur Chini. Maybe, just maybe, there could be some bit of upticks, if not today and in the week gone by. So we'll wait and watch for that as well. Okay, let's tell you what's lined up on First Word today then. It's the collection of the top editorial stories that we believe we should bring to you first up on the show. We take a look, needless to say, at the hits and misses in the fourth quarter earnings this season and how the performance adds up in FY18, and whether weak macros, uncertain politics and rich valuations make for a dangerous combination in the current financial year. We borrow some charts from Kotak Institutional Equities report on the earnings as well. Paint companies may be unable to sustain their higher performance going ahead as the material prices spoil the picture. We try and explore both sides of the scenario. And as we said, HDFC Bank, could that be the stock of the day today as the trading window for the FI is open? We'll ask Yatin for what he's learning from his sources. However, the first piece on First Word, needless to say, is all about earnings. We're at the end of the fourth quarter earnings season and we've had shocks and surprises in equal measure, even while an all-round earnings recovery still remains elusive. There are some green shoots in some sectors as well and some glaring red signals. Darshan is standing by with a roundup of how corporate India had fared in the quarter gone by. And Darshan, at least if you look at the Nifty 50 companies, that seem to be, compared to estimates, more hits than misses, but India Inc., or at least the sell side, has downgraded the earnings picture. What's happened?
Yeah, so basically they consider their stock of universe. We're just focusing on the Nifty 50, so that will be the big change that is there. Some like a Kotak takes the Sensex 30, CLSA has taken in their coverage into focus, Motilal, Oswal has taken their coverage. So it matters. We are dealing with the Nifty 50, and the reason we say either it's an above estimate, in-line estimate, or below estimate is simply on the Bloomberg consensus estimates. We take the financials into consideration, not so much in terms of, we take a little bit of commentary, but the number is something that we take a look at. Now basically the green ones are the ones that have come out with a strong set of numbers. A couple of financials, couple of oil companies there, construction companies, cement, auto, metals as a pack did extremely well. Among the mid caps, among the inline set of numbers, a lot of private sector banks is something that you can see. And on the weak side, oil and gas companies, you had a couple of auto companies and couple of pharma companies that were there that made a part of it. And as usual, Axis Bank and ICICI, again a weak set of numbers. So again, after the third quarter, they again featured. Even in the fourth quarter, they feature here. Now, in terms of what's happened from the last year, same quarter to now. So what we've seen is that the number of strong companies has gone down on a year-on-year basis. But if you see, there has been a gradual improvement over quarter and quarter. The number of strong companies have come down. The number of inline has also had peaked out but has come off, and the number of weak companies has also come up. So it's been a rather mixed quarter this time around. But if you see the graphs, you can see that at least the green and yellow lines are much above the red line. So it's been an inline to slightly decent set of quarter this time around. Now let's take a look at first which were the strong performers. Cement did extremely well, but there's just one company, Ultratech, in the cement. Construction did well, and there is only L&T here. Couple of consumer companies did well, financials did well, and metals did well. So these are the strong sectors among the companies that did well. And on the weak side, you had auto, oil and gas, and pharma. So Neeraj, this is the broad sector-wise performance.
So let's take a look at a closer look at the sectors, Darshan, and try and dissect that performance.
Yeah, so we'll take a look at some of the sectors. Now, auto not so good this time around. Eicher, weak set of numbers, even as sales were up. Maruti, it was a weak quarter for the first time since the first quarter of 2017. So Maruti's always come out with strong or inline set of numbers, and again JLR performance dents the earnings for Tata Motors. So not the best of season for the automakers this time around. Both Mahindra and Bajaj, both of them operationally a strong set of performance came in. Hero was in line. So autos more misses than gains this time around. Cement, yes, it was a very strong quarter. Ultratech quarter after quarter comes out with strong set of numbers. Higher volume growth, cost efficiency helped Ultratech. So the only cement companies, ACC and Ambuja are out. So this did well. The next sector that we want to speak about is the construction sector, and only L&T is there. Initially BHEL was there, it was out. So only infrastructure capital goods space is represented by L&T. Strong operational performance, but the management commentary had a bit of caution there. Even though they came out with a strong guidance, there was a hint of caution there. So, but nevertheless, the numbers were good. Now you're coming to the FMCG and consumer discretionary. The rural consumption continues to improve significantly. Volume growth was there on a favorable basis. So you had all your companies, you had the Titans, you HULs, all these companies in the FMCG space that did extremely well in trade. The next sector is oil and gas, which was rather weak. Upstream companies failed to report strong numbers. Despite crude moving up, probably this quarter you might see the move come in, but upstream companies didn't do well. BPCL was the only company on the oil marketing company that posted a strong number after 3 muted quarters. HPCL and IOC were in line set of numbers. The next sector that probably we want to talk about is the banking space. Now both Bajaj Finance and Bajaj Finserv did extremely well. Robust growth, strong outlook was seen. Strong financial from SBI, Yes Bank. Private sector bank, Yes Bank was the only one that managed to outperform. The others were in line. PSU, SBI, the financials were good. The asset quality was decent. The commentary was decent. And disappointing earnings again from ICICI Bank and Axis Bank. So this is what happened as far as the sectors were concerned. TCS was the biggest one that did well. Strong numbers. Stock managed to rally 10% post the numbers. Infosys, Wipro, HCL in line to slightly weak set of numbers, but the commentary was rather weak and rather cautious. So TCS was a clear outperformer as far as the IT firms were concerned. Metals, all the metal companies did well. Higher volumes, commodity prices were much higher. Overall, you name the metal company, it did well. Coal India, Tata Steel, Hindalco, all of them did well. And on the on the telecom side, Bharti Airtel did well. Strong Africa business was there. The better than expected India ARPU. So it seems that it's bottoming out after the Jio effect. And tenancy exits due to consolidation, among the service provider dented the performance of Bharti Infratel. So basically, this is what's happening. The other sector is pharma. Sun was the only one that did well. Strong financials, strong outlook, but the others weak set of numbers, and they expect pricing pressure to play out in FY19. So the outlook also was rather weak for the other pharma companies also.
So let's stack it up into numbers, Darshan. How does the overall earnings growth for FY18 look like?
Yeah, so we've seen a 9% EPS growth this time around. FY17, the actual number was 455 with the Nifty 50. For FY18, it was almost 496, which means a 9% growth that is there. And this is according to the calculation that we have done at Bloomberg Quint. So that's the number that's come out. If you see what the estimate is, FY19 we are seeing expecting a growth, we are expecting a number of 596, and for FY20 it will be 711. So a decent growth is expected, but nevertheless, when the street was expecting it will be tough. Nifty 50 still gave a growth of 9% on an FY19 basis. So basically this is the estimates that were there, and this is the actual that has happened in terms of the profit. From a profit of 2.74 lakh in 2014, that is FY14, we moved to almost 3.54 lakhs. So on a year-on-year basis, the growth has been rather decent, at least for the last 3 years.
Yeah, let's see if we indeed move up from this 9% to a 20% or thereabouts, circa 20% growth number. Darshan, as comprehensive as it can get. Thank you so much for putting all of that into perspective. That's our head of research, Darshan Mehta, with his thoughts on and some calculations on how the quarter has been like by and large, and what the numbers could look like. Now, I've just, as a follow-through to what Darshan has done, cumulative earnings growth have been marginally disappointing in FY18. Kotak Institutional Equities expects Nifty profits to grow about 23%, circa 20% essentially, thanks to a low base. But if corporate India disappoints once again, it will add to a potentially dangerous combination of weak macros, uncertain politics, and rich valuations. Just 2 or 3 charts. Firstly, in their note that they've come out, Exhibit 5, they're talking about how rich valuations of the market show its obliviousness to the weak macro. The turquoise blue line is the price to earnings multiple. The yellow line is the average, and mean plus 1 standard deviation is the top line. And as you can see that the turquoise blue line is trading in or around the plus 1 standard deviation level, which makes it very difficult for the market to stay at if indeed the other things don't, if indeed earnings don't work out, because the other macro doesn't seem to be working all that well. And let me try and take you through that. First, keep this chart in mind that we are trading above average valuations, and you can see that every time in the last 15 years when the market has gone above average valuations, it's tended to come off from those peak levels. We've come off a little bit from there, but in order to stay at those levels, the other things do need to work into place because the macros aren't exactly hunky-dory. Again, You can look at it both ways. GST collections have looked okay, the GDP numbers are looking okay, but just look at a couple of pressure points out here that people are pointing out or looking towards very, very carefully. The oil price pressure on macros and India's macro. While CPI, WPI, IP is all okay, fiscal deficit as a percentage of GDP, difficult to comprehend, but CAD as a percentage of GDP, BOP, the balance of payment that India has, expectations in FY19 aren't exactly the most rosy compared to what's happened in FY18, compared to what's happened in a few previous years as well. So these numbers strike a word of caution. Unless the micro works, the macro will play spoil sport. India's fiscal position looks similar to vulnerable emerging markets. Just look at a clutch of these emerging markets and where does India stand compared to some of the others, and that will give you a picture. What we are also trying to show, amongst other things, is India's external debt position, which is superior to the other emerging countries. And this is the total external debt to GDP in 2016, the released numbers that are there. And India stands a lot favorably. There are, of course, countries which are better than India. But if you just look at India, which is the fourth bar at 20.1, compare it to a clutch of other emerging markets, and India is a lot better. Sure, China is better than India on this particular ratio, but almost on all the other, compared to all the other world countries, India probably stands to trade a bit better on the total external debt to the GDP function. So there India is superior, but a lot of other macros, we've seen the turn coming around primarily to crude. But the long and short of all of this is that if the earnings don't pick up, then there's a potent cocktail which may not sit well with people who are consuming it. So Q1, Q2, Q3, Q4 become more important than they have ever been in the last 2 or 3 or 4 odd years. Will paint companies contribute to that? That's the question. They've had little to complain about in 2018. Almost all of them have had a good fourth quarter, and a shift to the decorative segment has started boosting sales. But rising raw material prices may just spoil the picture here on. Yash Upadhyay is here with the details. Yash, first, what's the math showing? And have you been able to speak to some market men to try and figure out what is their opinion on whether the paint companies will move up or down?
Yes, I have. So first up, as you rightly put, paint companies, they have reported a strong fourth quarter. So just a quick recap of what the numbers look like. Asian Paints reported a strong 14% jump in its Q4 revenues, led by a good double-digit growth in its domestic decorative paints business. This comes on the back of last 2 to 3 quarters of lean, higher single-digit growth in their volumes of the domestic decorative paint business. Kansai and Berger, they both reported a strong 17% jump in their top line. This was again led by a strong double-digit growth in their volumes for the decorative paint business. Analysts expect it to be anywhere in the range of 12 to 14%, as they don't give a fixed number for that. AkzoNobel reported a strong 10% growth in its top line. The bottom line looks optically good because there was a one-off gain of about 190 crores from the sale of its chemical business in the fourth quarter. So that's as far as the numbers goes. And after that, they did report a good set of numbers, and the stock reacted quite positively. We saw Asian Paints again as much as 5% the next day after coming with their numbers, and most of these paint stocks, they have rallied anywhere between 8 to 10% after coming with their numbers. But has the rally in the paint stocks run its course, and what can one expect when it comes to the second half of calendar year 2018, and what are the key risks to watch out for? So first up, we have the higher raw material prices. Now, raw material prices as a percentage of the total net sales, they account for more than 50% for a paint company. And what is this raw material basket? It mostly consists of crude and crude-linked derivatives like solvents and monomers. So first up, crude, that has shot up significantly in the last 6 months, and on a year-to-date basis, it's trading currently at about $77 per barrel. That is at a fresh 3.5-year highest level since November 2014. Next up, we are also looking at titanium dioxide. That goes into solvents used in these water-based paints which the companies use. That is up almost 7% on a year-to-date basis. So that is affecting their gross margin, and the gross margin picture, that should come up as well for these paint companies. Absolutely disastrous when it comes to their gross margins. They have gone from the levels of over 50% to 44.5% for Asian Paints, 42.5% for Kansai, and the rest. So that's as far as the raw material prices go. But that's not all. Most of these paint companies, they are trading at premium valuation. So if you look at their current 12-month price to earnings multiple, Asian Paints, that trades at 63 times its PE versus its 2-year average of 57.4 times. Kansai Nerolac is trading at 50.8 times versus its 2-year average of 38 times. And Berger Paints, that is trading at about 61 times versus 56 times its 2-year average. Also, because of these steep valuation, analysts believe that there is limited scope for an upside. And if you pull up the ANR function of the Bloomberg terminal, you will see the Bloomberg consensus target price and the upside potential that these stocks offer. Asian Paints analysts believe could see a 0.5% of an upside from its current levels. Berger, Kansai Nerolac, a 9.4%. Now, why is that so? Well, a bit of an FYI here, Kansai Nerolac on a year-to-date basis has fallen as much as 15%, and that is the most affected by crude oil prices. One, because it has the highest share of industrial paint business, so there it's a bit difficult to pass on the higher raw material prices because there is negotiation involved. In terms of other companies, they can easily hike the prices and pass it on to the end consumer. Berger analysts see a 10% fall from the current level, while AkzoNobel analysts see a 3% uptick from the current levels. As far as speaking with the market expert, we caught up with Deven Choksi. He's a regular at Bloomberg Quint. We spoke to him to try and get his perspective on what the valuations look like, and he seems to believe that most of these paint companies, they are richly valued, and if as an investor you are comfortable with a return of about 10 to 12%, then this would be one pocket that you should look out for. But in a long-term perspective, his top pick continues to remain Asian Paints, which is the market leader. He believes that the new capacities coming up over the next 2 to 3 years, its rich brand and the market leading position, that would help it in the long run to be the top gainer. Back to you.
Okay, so this is Deven speaking officially on record, right?
Yep.
Okay, thanks a lot for that, Yash. So that's, well, the quick analysis on the paint companies. Lastly, to what is arguably going to be the stock of the day. It was supposed to have started off from the 1st of June, but for depositories which sought some more time to provide all the data, foreign investors can now pick up stake in various Indian companies via the stock exchange, nearly real time from today, provided it is within the total FII cap. Yatin Johnson to talk about the new mechanism and then some of the stocks that stand to gain from it. I know all eyes are usually on HDFC Bank, Yatin, but first educate us about the new mechanism.
So, Neeraj, you know, the data from the depositories was supposed to come into the exchanges on 1st of June, you know, which was Friday, but unfortunately the depositories, both CDSL and SDL, were not able to combine a common file and, you know, provide the data for the exchanges so that, you know, they can raise the red flag or probably stop FII purchases if the data or the, you know, total limit was breached. You know, but finally post the market hours on Friday, we had the depositories, you know, putting up the files and, you know, the necessary data, you know, to the exchanges as well as on the public platform, which is their website. And now, you know, it seems that there is sufficient headroom for various companies which were under the, you know, RBI caution list or, you know, probably the ban list, if I may put it so, because there was a 2 percentage points buffer which the Reserve Bank and the regulators used to keep. Now the fact is that this mechanism will be real time, which means that there is no requirement of a 2% you know, a buffer. Instead of that, the limits will be monitored on a regular basis. So if you look at the current limit available in HDFC Bank for FIIs to buy is close to 4.35 crore shares. In the case of IndianOpen Bank, it is 1.2 crore shares. And in companies like smaller companies like Suntech Realty, that quota is close to 18 lakh shares. So this is the FII headroom which is available as per the limit set by the regulators or approved by the shareholders. Of course, in the case of HDFC Bank, it will hit the sectoral limit of 74%, and in the case of IndianOpen Bank, it will hit the 49% you know, FII limit which has been set. Now, Macquarie does believe that this will lead to a buying of close to $1 billion or plus in the case of HDFC Bank. And also, scrapping of the FII window will increase the quantum of the buying both in the domestic market and the ADR. Morgan Stanley, they maintain a buy with a target price of 2570 on HDFC Bank, and they also believe that this mechanism will lead to a probable buying of $1.1 billion in the case of HDFC Bank. And also, we have the HDFC ADR, which has started to trade at a premium since you know, the exchanges will be scrapping the 6 lakh series, which is basically the FII window, and the only window for FIIs to trade between them, since they, you know, they cannot buy it from the open market under normal circumstances. That ADR premium should shoot up according to brokerages. So now the system from today, since the data is available, and we spoke to the stock exchanges, they said that once the data is available, the mechanism will start, and hopefully from today, we will have the real-time monitoring of FI limits, and probably HDFC Bank, one of those blue chips, will be in focus because this probably last chance, or probably a chance which FIs don't usually miss. Last time this phenomenon happened in Feb of 2017, so the date was 17th Feb 2017, when really this limit was opened up under the 2% buffer system, and we had FIs clearly buying aggressively on that day. Delivery volumes were huge. We had a 10% intraday move. At that time, the price was 1,300 rupees. The shares went up as over as 1,400, 1,450 rupees in that intraday trade. So let's see really how does it work in trade today, because 4.5 crore shares odd is certainly a big amount of buying that FIs can do in opening hours of trade.
Well, let's wait and watch, and which is why, while it's applicable to a bunch of other stocks, HDFC Bank, by virtue of it being what it is, tends to be in focus. Yatin, thanks for putting that into perspective. That's the new FI monitoring system, or FI holding monitoring system, and its impact thereof. But that's all that we have on First Word for you, at least. Lots lined up on the show. We talk about earnings and macros throughout the show today. Firstly, Manish Sonthalia, head of equities at Motilal Oswal AMC, very special voice, joins in 9:15 to talk about his thoughts on where would he put money to work. And then, as we've been talking about how Q4 earnings have shaped up and what could happen in FY19, Suhas Harinarayanan of JM Financial joins in to speak about how is it that they have dissected Q4 and what is their outlook for the earnings for FY19. But all of that is a bit later on in the show. For now, we take a break and shift focus to the day's trade on the other side.
Sorry, I'm late. क्या हुआ?
कुछ नहीं यार. Just working on my expansion plan.
Funding का चक्कर.
It is so frustrating. I feel like banging my head against the wall.
No, don't bang your head. Cross the bridge instead.
Bridge?
हाँ, ये देख. ला.
अरे.
This bridge gets you in touch with interested investors. Funding happens, which means more outlets, more customers.
Interesting. And what exactly is this bridge?
A stock exchange created for your kind of company. Just list on it and help your business expand.
Really?
Yeah.
तो फिर लिस्ट कर लूं?
और क्या? शुभ काम में देर किस बात की? चल.
हाँ.
NSE Merge, साथ हमारा, सफलता आपकी. The SME Growth Platform from India's largest stock exchange.
RP Sanjeev Goenka Group, growing legacies.
Anything and everything about your investments. We're just a touch away. Monday to Friday at 12:30 p.m. only on Bloomberg Quint.
Welcome back. You're still watching Indian Open with us on Bloomberg Quint. Let's take a look as to what's happening with the Asian markets this morning. Well, it's green across the board. It's a good start to this new week. Nikkei is trading with gains of over 1%. Shanghai is sitting with gains of about 0.4% as we speak. And Hang Seng has seen good gains of about 400 points as we speak. Remember, the start of the June series was not so good on Friday, where Nifty saw cuts of almost 40 points. But SGX Nifty this morning is once again indicating a start above the mark of 10,700. Let's see if the opening is in sync with what SGX Nifty is suggesting. But important to tell you what sort of cues we're getting from the derivatives market. Agam Vakil joins us to tell us the same. Hi Agam, good morning.
Good morning, Navneet. What we saw last Friday was a little bit of a come off for the benchmark indices, with the Nifty declining by as much as 0.4%. Some shorts building into the system, as much as 2.6% in terms of the open interest. For the Nifty Bank
however, there was longs unwinding, considering we saw the open interest decline by as much as 4.5%. Coming down to the volatility index, as one might expect, it did move up by as much as 2.7%, still within the range of 13 and 14. And when it comes to the Nifty put call ratio, surprisingly, despite the fact that we did see the Nifty come off, the Nifty put call ratio went up to the mark of nearly 1.5. So there were more puts written. Now, let's also take a look at how we are looking at your changes in open interest across the different strikes. And we have seen a little more support building around the 10,700 mark, as you can see here. There's a little more writing coming along. This is the 10,700 put, and a lot more writing coming along in the 10,900 and the 11,000 call, which also gives you a near-term resistance zone. Let's also take a look at how that has been distributed across all series and across all strikes. As you can see, the base formation around 10,600 on the lower side, and 11,000 call, considering it has maximum open interest, that will provide that near-term resistance. Moving on, taking a look at some of the stocks, we have Torrent Pharma, which continues to strengthen further, even as we see another 35% added in open interest. On the losing end, we do have Just Dial showing a little bit of volatility, perhaps profit taking, but we have seen about a 35% increase in OI there as well. And finally, TVS Motor Company, along with a lot of other auto stocks which did very well last Friday. We did see the stock move up around 1.6%, and of course open interest increase substantially towards longs, and we wait and watch whether or not some of these auto stocks continue their momentum that we see start last Friday.
We'll watch out for that. Thanks a lot for that, Agam. That's Agam Vakil with the FNO setup for the day. We will get in our derivatives experts in about 15 minutes and talk to them about some of these as well. But now, getting a fundamental voice on the show, Gurmeet Chadha. He's co-founder and chief executive officer at Complete Circle Consultants, joins us right now on the show. Gurmeet, good having you. Thanks so much for taking the time out. The world seems to be a happy place. Crude is cooled off a little bit as well. Albeit you don't know what the going ahead would be like. What are you doing, Gurmeet, in the current scenario? Are you putting fresh money to work?
So Neeraj, I think you rightly pointed out with crude concerns slightly easing off. I think one key aspect here which needs to be highlighted is, revisiting that old theory of earning yields versus bond yields. And if you see, in India currently at, earning yield for viewers is basically the reverse of PE multiple, is currently at about 4.5%. And your bond yields are touching around 8%. So incrementally, as far as the fresh deployment goes, we've been telling clients that the bonds also offer as good an opportunity in the short to medium term as equity does. And I think till the time these bond yields settle, for us to have a comparison in terms of which is more attractive, I think the markets will continue to be a little edgy. And this is also being driven by the global developments. So US had great job data which came in last week, which could fasten the pace of hikes. So I think the bond yield should settle in some time, and we are advising clients to have a very, very balanced view on both asset classes and capture the low-hanging fruits.
Hi Gurmeet, good morning to you. Well, clearly rate hike from US has been in focus in 2018, but back home this week, the focus also shifts to RBI. We've got the meeting lined up on June 6th. What are the expectations there? What sort of tone do you expect from MPC this time around?
I think MPC has been, catching the market off guard, with the string of, conflicting statements coming. But I think if you take our consensus view, I think this policy would be more a withdrawal of accommodative stance rather than, a rate hike. While they still might do a marginal hike, but it looks like it will be more a withdrawal of accommodative stance. And also, I think the fact is that they would like to have a more longer-term view on inflation. I think if you break the CPI broadly, you see the food inflation has been not been a big concern. It's the core inflation which has been a little sticky. But I think the government has addressed the supply side of it pretty efficiently. So I think while the longer end of the yield curve is pricing a couple of rate hikes this year, so a rate hike per se may not be a very big event for bond markets, but looks more like a withdrawal of the accommodative stance for now, and wait and watch.
What's the expectation from HDFC Bank today, Gurmeet?
Yeah, see, I'm Neeraj, a long-term bull on HDFC Bank. I think this will be the second company in India which will have the distinction of being the 100 billion market cap club. I think with the FI window opening today for almost 4.3 crore shares, I think we'll get a further leg up. I think that importantly, if you see HDFC, and you would have tracked it over so many years, I think what is impressive is the way it grows 1.3 times the market does. So typically, Bank X grows 1.5 times GDP, and HDFC Bank typically has been growing 1.3 times the Bank X. And so I think HDFC will continue to do well. I think this is a must-have across portfolios, whether those are mutual fund portfolios or your individual portfolios. I'm also very, very positive on the retail lending side of the bank. There are a lot of digital initiatives they have done. In fact, the loan on mutual funds and shares, the short-term loans, I think their digital initiatives would really make the lending, the retail loan book, which already is growing 22%, go further up. And there is a big opportunity on the third party and the referral income which they have. I think that could surprise, and can add possibly another 500,000 crores on the bottom line.
Well, HDFC Bank will definitely remain in focus. Also remember, it's a heavy weight on your frontline indices, 10% weightage on Nifty, and also it's a heavy weight on Bank Nifty. But Gurmeet, is it a top pick in the private banking space?
Absolutely. If you see the asset quality, if you see the CASA book, that's almost 45% of the deposits. Their NIMs are almost 4.3, 4.4%, which is again best in class. If you see, there's also a lot of value in some of their subsidiaries, which are like HDB Financial Services, HDFC Securities. So I think if you see across parameters, I think the bank really holds out and has to be a top pick across portfolios.
Okay, we'll be watching out the opening of HDFC Bank, and let's not forget, when this window was opened last year, there was an aggressive buying which was seen from the FIs. Besides HDFC Bank, there are a whole host of other stocks which will be in focus when the market opens today. Let's head across to our research team to find out the details of all those stocks. Well, here's our research team. Good morning to all three of you. Agam, let me come to you. Which are the stocks that you're monitoring?
Sure, I'm going to start off with some banks and some institutions which have hiked the prices, or rather rates. And I'm going to start off with SBI, which has hiked its MCLR rate across all tenors from 1st June. We also have Karnataka Bank, and that's where we've seen the rupee term deposits hike to as much as 7.25 from around 7.1. And HDFC has also hiked its retail lending rates by as much as 10 basis points. In terms of fundraising action, we also have Canfin Homes, which is looking to raise 6,000 crores via NCDs and bonds, and another 1,000 crores via rights issues. We have OBC, which also seeks to raise 3,000 crores via QIP rights issue in FY19. And Idea Cellular, this perhaps will be a more important one. This is a relatively larger sum where they're looking to raise around 15,000 crores via an issue of non-convertible securities. And moving on, in terms of some inspections in the pharmaceutical space, we do have Dr. Reddy's, which will be in focus, where the US FDA has completed its inspection in the Srikakulam facility with no observations. And we also have Cadila, which has got a regulatory nod for one of its drugs, doxycycline hyclase capsule. And keep an eye on that one. Of course, Dilip Bilkon, which has been very volatile over the last few days, gets an order worth well over 1,300 crores. And Hero MotoCorp sales are up as much as 11%. So that's what we are tracking in terms of stocks and news this morning.
Thanks for that, Agam. Well, finally some good news for Dilip Bilkon. But I guess there was an analyst meet for Cummins stock, which has corrected a lot from its top.
Yeah, so it's down 40% from its all-time high, and then concerns remain because growth is not coming in, especially in the export market. So basically, a couple of reports have come out, and the broad theme is that this was mainly to restore the investor as shareholder confidence. What is happening? A lot of MNC companies, they've been shifting out some of the key India operations to the private companies, not the listed entities. But Cummins has said that for India, Cummins India Limited will be the front where where domestic operations will happen. They will not shift shift it out to a private company of the global parent. So that is something that was said. Guidance maintained, what they've said is that for the domestic market for the next 5 years, they see growth of 9 to 11%, and for the export market, they see growth of anywhere between 0% to 5% for the export business over the next 5 years. So that's what basically come out. Management emphasized that there will be no market share loss, so they continue to remain market share leaders in the genset markets, and they don't see any kind of loss that will come in. Business will improve once India completes the move to new emission norms, and that is where because of their market leadership, they will be in a much stronger position. Key areas that they like, where growth will come in: telematics, electrification, renewables, alternate fuels, and advanced analytics. And they have no willingness to participate in the telecom market because that has become highly unprofitable for them.
Okay, thanks for that, Darshan. But Coal India, I guess the offtake and the production numbers for the month of May have been released, right, Nikki?
Yeah, and they missed the target this time around as well. But then healthy set of numbers if you look at year-on-year basis. Production has seen almost a 16% uptick, while the offtake figure is up 14%. Production has come in at 47.1 million ton, and the growth is mainly on account of the base effect. Now, back in May 2017, we saw a production decline of 4%. All subsidiaries except NCL have reported a shortfall in terms of the production target. In terms of offtake, as I just mentioned, it's a 14% uptick there at a number of 52.9 million ton. The offtake shortfall was seen across the subsidiaries. What Nomura has to say, it has maintained the neutral rating on the counter and the target price of 332 per share. It has forecasted a production offtake target of around 8 and 7% year-on-year basis for FY19, and said that to achieve so, we will have to have a run rate at least for the first 10 months to a number of around 1.7 million ton per day.
Okay, thanks for that. Coal India was down almost 0.5% in Friday's session. Thank you, all three of you. But Gurmeet, if I could take the Hero Motor sales number which were released, well, I think slightly above what the street was estimating. It's just not about Hero Motor Corp. Markets were weak on Friday, and we were getting the auto sales number for the month of May, which have been pretty good. Some of them were above the street estimates. What's the approach that you've adopted towards the auto pack, considering a lot of market participants are talking about the recovery in rural market? And commercial vehicle, that space has been quite buoyant in the last few months.
I think most portfolios are overweight auto, rightly so. If you see the utilization levels are pretty high. They are in their mid 85% plus. Why Hero? Even look at even the Bajaj numbers. I think there's almost been a 30% growth in volumes. So I think auto, as I was also watching your show on value migration, and I think what we are seeing is a big surge not only across. So while we have 2 crores of two-wheeler sales, you also have about 32 lakhs of the passenger car sales. The tractor numbers are clearly picking up. So are the commercial vehicle numbers. So I think there is growth all across, and I think one should also go level 2 in auto. I think if you carefully study the supply chain mechanics and the dynamics of the auto industry, the capacity addition in auto ancillaries goes up with a lag. So once the utilization level pick up in auto, the ancillaries tend to be the first beneficiaries in terms of increase in profitability. So it has to be a combination, and there are a lot of segments which were earlier commoditized, where the brands are coming. So look, for example, batteries, or if you look at some of the fasteners, companies like Sundaram Fasteners. So I think another one which had a stellar number was Minda Industries, which is largely into auto sensors and anti-theft locking systems. So what you will see is even the auto ancillaries picking up because of the capacity constraint and the enhanced utilization of those capacities.
Interesting. Gurmeet, one stock that's really come of age in the last 2 odd months post the Maggi fiasco is Nestle, right? Big bang moves the last week on Friday, almost nudged the 10,000 mark. For somebody who's been holding on to the company, are valuations a matter of concern, or do you believe companies like Nestle, Britannia and the others will continue to find favor?
Neeraj, I don't see a matter of concern. I think the incremental returns could come in maybe single digits or high single digits. from a long-term perspective. So whether it is Nestle or Gillette or Britannia, because of obviously high valuations. But what I've been emphasizing in our discussion is that with the destocking complete, what we are seeing is a shift, an increase in market share of organized players, and I think the trend will likely to continue, whether it is even domestic ones like Imami and some of the others. So I think what we are seeing is a percentage increase in share of the organized players, and I think for maybe coming 2 or 3 quarters, I think you will see the stronger brands registering double-digit volume growth. Also, I think with a lot of these auditor issues, corporate governance issues, being in the limelight, I think you will see a little more premium to some of these MNC names, which will probably stand out.
Okay. Gurmeet, stay on. So much more to talk about. It's 8:45 though, almost 8:45. That time of the show where we move towards the charts for a bit and try and figure out what could happen in the intermediate term or the near term as well. Amit Harchekar, he's the director at Index Genius Investment Advisors, joins us on the show, as does Ruchit Jain, he's technical analyst at Angel Broking. Gentlemen, both of you, very good morning. Many thanks for taking the time out and being with us. Amit, we'll likely start off with a small bit of a green tick. The world markets are showing that, the SGX is showing that. What would be your trading strategy for the day or for the week be?
Well, I would be quite positive on the markets after we have seen a very strong breakout in Bank Nifty above 26,800, and we believe now the Bank Nifty is all set for testing levels of around 27,800 in next 1 or 2 weeks. Now, from Nifty perspective, we have seen massive build-up of short positions around 10,550, 10,600, and that is the only case we had seen first-time rollover discount of around 30 points. So there are a lot of shorts in the system. So we believe that is enough to drive these markets higher. From Nifty perspective, I would say one should buy Nifty even at current levels. Stop loss should be at around 600, and we are expecting target of 10,900 in next 1 or 2 weeks. And we believe banking would be the key driver, and the index or the space where we have seen maximum decline or shed in open interest was commodities and energy space. We believe that would be another sector which would see a good rally in the near term.
Okay, that's the view on the markets coming in from Amit. Ruchit, what about you? How would you play the index today, Nifty or Bank Nifty?
Yeah, hi, very good morning. Well, during last week, we clearly saw a divergence in large cap and the mid cap space. Well, the large caps have started forming a high top, high bottom structure. Many of them definitely led by the banking index. But the mid cap space has certainly been correcting in spite of the positive momentum which we have seen in some of the large caps. So I think this trend would continue during this week as well. Although on the index front, we are not expecting any significant correction. So because of the momentum that we are witnessing in the index heavyweights, I think if one has to take a call on the index, then Bank Nifty would be appropriate index to go long on. Simply because of the outperformance that we have been looking in names such as HDFC Bank, Kotak Bank, IndusInd Bank, which are the heavyweights, and even from the PSU space now, SBI has also started showing some strength. So as far as trade setup is concerned, one can go long on Bank Nifty amongst the indices, keeping a stop loss below 26,500 and expect target around 27,100 to 27,200 range.
Okay, interesting. Let's try and then therefore nail it down first to some specific stock ideas from our guest. And Ruchit, let me come back to you first. What are your stock recommendations for this afternoon, for this morning, excuse me?
Yeah, I have a couple of buy recommendations and a sell recommendation as well. One is a buy in Cholamandalam. This stock has shown a good outperformance since last few months, and after this corrective move, we have seen that the correction has been backed by very lower volumes compared to what volumes were seen during up move. I think the stock should resume its uptrend from here on. One can buy with stock below 1540 for short-term target around 1650. Maruti is another stock which in last couple of trading sessions the stock has seen an up move backed by good volumes. So after this corrective move, I think at least a good pullback move up to 50 to 61.8% retracement of the previous correction should be seen. So one can go long in Maruti, keeping stock below 8640, expecting target around 9115. And Apollo Hospitals is one stock on the short side. In last 2-3 trading sessions, we have seen that there is a lot of short formations have been happened. The stock is trading in a falling channel and the previous supports have been breached. In spite of the positive momentum in the market, this is one of the stock which is trading at its 52-week low and all the supports have been breached. So we believe that underperformance would continue in Apollo Hospitals for short term. One can sell with stop loss above 958, expecting target around 880 within 1 week's time frame.
Okay, 2 buys and 1 sell call for the day coming from Ruchit. Amit, what about you? What are the top trading ideas for the day?
Well, my first pick would be buying Reliance Industries for one reason. It contributes nearly 53% weightage in Nifty Energy Index, and now Nifty Energy Index is poised for a rally of at least 14% in next 2 to 3 weeks. So we are recommending buying Reliance Industries at these levels. Stop loss would be 889 and our target would be minimum 1000. Second stock would be buying ITC futures. Again, if you see the medium to long term charts, it has formed a cup and handle pattern, and that projects you minimum target of at least 300 plus. So from a very short term perspective, what we would suggest buying ITC futures with a stop of 264. We are expecting minimum target of 286.
Okay, interesting. Sticking to large caps is Amit Harchekar, and a couple of balancing out strategies coming in from Ruchit Jain for the day. Okay, gentlemen, stay on. It's 8:50, that time of the show, wherein we move to our special segment, Bloomberg Edge, wherein Jayesh Kilnani tells us about a pattern that the Bloomberg terminal has thrown up on a stock. Jayesh, what's the stock on your radar today, and why?
Morning, Neeraj. So the Bloomberg is suggesting that there could be long positions built up on Bata, and there could be further upside as well. That is because the stock is taking support at key moving averages of 50, 100 and 200-day moving averages. In fact, the 50-day DMA is very close to where the current price is also. And also that, after a long time on the weekly chart, there has been a buy indication. So let's have a look at the fear and greed indicator, which has triggered this indication. It's a proprietary Bloomberg indicator which uses the spread of 2 weighted moving averages of the true range as one of the key inputs for calculation. What it does is oscillates on a zero baseline and therefore becomes very simple to interpret. You simply follow the color to get your buy and sell signals. Green gives you buy and red gives you a sell signal. Watch out for a color change and you'll get the direction of the buy and the sell signal respectively. Now, if you have a look at the chart of Bata, that's the last weekly chart that you have. The bottom panel, what you see is there is a green bar over here, which it has turned green after a couple of weeks being in the red. So which means that the uptrend that was there, this is likely to resume. So there is a buy signal on the weekly chart of Bata.
Jayesh, what's the efficacy of this indicator?
Navneet, works very well. If you had bought all the indications in the last 1 year, net profit would be about 22 to 23%.
Okay, Jayesh, thanks a lot for bringing those details with regard to Bata India. We'll be watching out for the opening of that one. Let's quickly take a technical view also from Ruchit on this one. Ruchit, on the charts, how is Bata India looking?
Yes, certainly, I think Jayesh has explained it very well. The key moving averages initially which he talked about, yes, according to that, I think the stock is quite placed near its support levels. And the downside from here on seems to be very limited. Now, if we even see the 200-day moving average, the stock started rallying in March 2017 when the prices were around 500, 510 range. Post that, as of now, from 500 to 760 or 800 range we have reached, but the stock has not breached 200-day moving average on a closing basis, or if I may say, it has not sustained below that below 200-day moving average. So I think the risk-reward ratio is quite favorable at current levels. One can buy with stop loss below 735 from a short-term to medium-term perspective. I won't be surprised if the stock reaches its all-time high, earlier all-time highs around 830 very soon.
Okay, that's the technical check on Bata India. Let's see how the opening would pan out, but Ruchit too has a buy. He's suggesting a buy on this one. Gurmeet, let's talk about some individual stocks which have corrected a lot in the recent past, and one of them is Dilip Bilkon. Despite of the rumors, management coming out with the clarification that the auditors are still there and they're not looking to resign anytime. We also spoke to the management. The numbers were pretty much fine. The brokerages have maintained their rating. They've not cut down any sort of target. Would you look to look at stocks which were appreciating in the recent past and have corrected a lot? Do you think it's a good entry level for somebody to buy Dilip Bilkon in their portfolio?
Yeah, I would think so. As I said, I think in the EPC space, I think the road developers are the best play right now, because the executable order book, there are visible signs. Also, it gives you a lot of political capital when you see some of these infrastructure projects getting completed, this being an election year. So I think the focus of the government, the focus of will also be to award more and more projects and gain more and more limelight. We recently saw the mileage which the Eastern Peripheral Expressway got in the NCR region, doing that. And as you rightly pointed out, I think the concern on audit and some of the corporate governance issues seems to be ebbing out. I think a staggered approach could be better. It has a very good order book, and I think it's a good stock from a medium to long term perspective. Only issue is staggering the entry and being a little patient in this market. And I think that's with most stocks.
Is this Gurmeet, is this a Dilip Bilkon specific concern or a market specific concern? The staggering out would imply that you believe that there is a chance of a stock dipping to lower levels.
Yeah. See, Neeraj, as I said, this is, I think, the broader market concern. And if you see, while the market headline numbers show that they have been fairly resilient, but if you see the breadth of the market, I think it's a great time for portfolio builders, for especially people who are sitting and have some liquidity or cash in their portfolios. So I think one has to just sit back, be patient, wait for the opportunities, and I think market will give you plenty of them. I think we are in a in that kind of a zone where we have every day some new developments happening globally and domestically. So patience would be the key this year.
Okay. Dilip, some chatter on our social media pages about companies that are doing very well or otherwise. And remember, I asked you about Nestle. That stock hit 52-week highs. Now, what's your thoughts on the other one? If you track Merck, Merck has consistently been doing well the last few days. Yesterday, too, about 9 or 10%. Fundamentally, has it kind of run its course because of the technical triggers to Merck, or do you believe that somebody can hold on if you have maybe a long-term view in mind? Do you track this one at all?
So not very closely, Neeraj, but I think this is one stock which obviously has been news, especially with it inching up, quite a bit last week. My view, as I said, I think the issue is not downside here. I think the issue would be incremental returns. When you're sitting on those kind of valuations and coming back on a large jump in price, it will tend to consolidate. So I think it will be the higher single-digit returns expected from stocks like Nestle, Merck, Gillette, even Lever for that matter.
Okay, the top gainer, however, on Friday was Bajaj Auto on back of good monthly sales numbers coming about. Amit, it was up almost 5% on Friday. Let's say if somebody were carrying home the long positions on Bajaj Auto, what would be the levels on the upside to keep an eye on?
Well, the rally can easily extend towards 3050 to 3080. Now, the only thing is the pivot point for this current up move is at around 2830. So, what I would say is that should be the stop loss for your long position. If that gets broken, you can see another attempt of testing the low of around 2700. So, 2830, I would say make or break level from the short term perspective.
Okay, let's see whether the buying continues for Bajaj Auto or not. But Gurmeet, you said there are a lot of opportunities for portfolio builders. Can you talk to us about few opportunities or few stocks which have corrected a lot that you're monitoring and that can be picked up at current levels?
Yeah, so I think again, being an occupation bias, I think the NBFC and the banking space looks very, very promising. While we have discussed HDFC Bank, and another company to look out is IIFL Holdings. I think if you see and you break the business into three parts, which is essentially broking, wealth management, and NBFC and lending, I think all three seems to be doing very, very well. And my sense is that you could see an huge incremental growth both in the NBFC and the wealth management piece. I think the way we are seeing new clients being added and a lot of initiatives being taken on lending, both digital and otherwise, in terms of expanding the presence. I think this will add tremendous, growth in both in top line as well as the bottom line numbers.
Gurmeet,
the other one which you can look at,
No, please carry on. Yeah. Then I have a follow-up question. Maybe we'll take that follow-up question post-market open, but please finish your point.
See, the other one is Bata. I think what we are seeing is, obviously it's a strong brand with MNC patronage. What we are seeing now is that Bata historically has been very, very low spender on advertisement and promotion, which is less than 1% of their top line numbers. Of last 3 quarters, we have seen that they've increased it to about 2.5–3%. More stores being added, more retail square feet displays being added, alternate revenue models being built, and I think there's a big focus on increasing the women accessories as well as the women footwear share. Currently, that contributes to about 29% of the volumes, and with brands like Scholl's, Hush Puppies, Marie Claire, and they have a good portfolio of some strong power brands. I think Bata could also be a good consumption play, from a long-term perspective.
Okay, so viewers, Bata as a consensus buy, be it on back of fundamentals or even technicals. We checked with Ruchit. He also suggested that it can be bought at current levels, which is 765. In the last 1 month, however, it has been just about flattish, down 1.5%. Well, 16 or 15 seconds to go for the pre-opening rates to come on the screen. Remember, the handover from US was good. Across Asia, we are seeing green ticks this Monday morning, and SGX Nifty is also suggesting a start which could be higher above the level of 10,700 after a weak closing for the week that we saw on Friday, which was the day 1 of the June series. Those are the pre-opening rates there on your screen, indicating a positive start. But let me tell you, these rates are going to settle down by 9:08. So 10,790 as we speak for Nifty. Sensex also trading with gains of almost 300 points. Important to look at a couple of individual stocks first, and I want to pull up HDFC Bank. Remember, the new monitoring system, the FI monitoring window opens today, and that's indicating an uptick of 3%, which could lead to some bit of buying coming in from FIs as per some reports. Besides HDFC Bank, a couple of other gainers among the Nifty constituents as we speak. Pull up Dr. Reddy's Laboratories. Remember, that's the one in focus after US FDA has completed its inspection at Srikakulam plant with no observation, and that's also starting the day with a positive tick. ONGC is showing some wild moves this morning, but the rates will settle down, I believe, 10% higher. ICICI Bank, HDFC Bank, both of them showing an uptick of over 3%. Dr. Reddy's, I mentioned Power Grid, GAIL are a couple of other Nifty constituents which are likely to start the day in the positive territory. On the losing side, your heavyweight Reliance is seeing some negative tick, down 1%. Tech Mahindra, HUL, which has been doing pretty well in the recent past, is showing a cut of 1%. And also Sun Pharma and Coal India. Remember, Coal India offtake and production numbers had come for the month of May, which was slightly below what the street was estimating. I just want to pull up Canfin Homes. It was down on Friday, and there's an update on that. Board has approved raising up to 6,000 crore via bonds and also 1,000 crore via rights issue. So watch out for this one.
Yeah, let's see how it goes. So ONGC, well, strangely, is showing a big spark. Let's wait and watch. HDFC Bank, not a really big gain, just about a 3% high. But remember, HDFC Bank had already gained in Thursday's session. If you remember last week, Thursday, it's a big move there. That is not to say that I'm trying to debate the quantum of the move here, but just the fact that keep in mind that there was a move that has happened in Thursday's session already for HDFC Bank. Amongst other stocks, ICICI Bank and IndusInd Bank look like they'll start off on a positive note. Let's wait and watch. Do watch out for these as well. I want to bring up 1%. Quality, Atlanta, Kaplan Point, some of the top losers in Friday's session as well. Quality, a flat start for almost all of those. In fact, all of them have a flat start, which brings me to Dilip Buildcon as well. I actually showed some bit of a buying in Friday's session. Let's see if there is some more continuation there. Yes, indeed, certainly seems to be the case. What's not doing well, likely not doing well, is Rain Industries, likely to start off on a slower note. And some gains in Sudarshan Chemicals, though these may be too early to predict. Let's wait and watch. Let's give them a chance to settle down. The currency should come up on your screen. Big surge On the gaining side for the currency, 67.06 then and 66.88, in large part attributable to the demand for HDFC Bank demand for currency for HDFC Bank buying. Let's wait and watch if this continues, or does this succumb to some bit of selling pressure yet again. For now though, from scares of hitting those lows, all-time lows, we back to 66.85. It's been a remarkable pullback for the rupee. The bond yields, though, I doubt would have shown the same gumption despite the crude fall. 7.85. The RBI policy this week would ensure that the bond yields don't really react too much ahead of the policy. The base expectation seems to be that there could be some tinkering with the rates. Let's wait and watch. For now, get in Amit Sarkar, who joins in with the big brokerage calls for the morning. Amit, good morning.
Good morning, Neeraj. On the big brokerage calls for the day, first we have a City on Steel Authority of India Limited. Now, the brokerage has raised the rating on the stock to neutral from sale and has also raised the target price to 83 from 50 rupees. Now, the fourth quarter EBITDA per ton for the company was the highest since 2011 on the back of higher steel spreads. And going forward, the brokerage is expecting these higher steel spreads to sustain on the back of the better than expected China steel demand, continuing supply limits and falling inventory levels. Now, the company management is targeting a 28% volume growth, which according to the brokerage may be a bit more stretched, but the brokerage is still expecting a strong volume on the back of the fact that the other key players, that is JSW Steel and Tata Steel, are running at high utilization levels, and the assets under IBC proceedings are pending ramp up. On the back of this, the brokerage is expecting strong volume growth from steel. Now, the brokerage is also expecting the company's net debt to EBITDA to fall to around 3 times by FY20 versus 9 times in financial year 2018. Lastly, the brokerage has hiked the FY19 and FY20 EBITDA estimates by around 26% and 25% on the back of higher steel prices. Second, we have a Credit Suisse on India automobile sector. Now, in May 2018, the passenger vehicle demand accelerated and was the key highlight according to the brokerage. Now, the industry volume grew around 17%, driven by Maruti, Tata, Honda and Toyota. Along with this, the tractor segment saw a strong annual volume growth of around 25%. For the commercial vehicle segment, healthy volume growth was seen with some market share gains for Tata Motors. Now, for the two-wheeler market, it was another month of double-digit growth led by Bajaj and Hero MotoCorp. Lastly, among the auto sector, the brokerage is preferring Mahindra & Mahindra and Escorts because of their exposure to the tractor segment, and it also says that Ashok Leyland and TVS are losing share to peers.
Thanks, Amit, for bringing those big brokerage calls for the day. City on sale, where they've increased the target price and also changed the rating to neutral from sell. Gurmeet, any thoughts on Steel Authority? I remember SAIL and JSPL, which were the dark horse in this sector, saw some traction in the last few months, but there was huge amount of profit booking that kicked in for Steel Authority post its earnings.
I think there could be a short-term upside, but once you stick to the larger players and the better organized players, which are Tata Steel and JSPL in this play. I think I've been speaking to a lot of promoters in the automobile space, and there is a genuine steel shortage. In fact, from 1st of June, even the cash discounts are to go. So a lot of forging plants guys, a lot of the automobile guys are facing some steel shortage because of the enhanced demand. So that could be a bit of a kicker for some of these, the larger steel players. And there could be also be because of the reduction in discounts and others, I think there could be a bump in profitability as well. But steel and other metal cycles are cyclical, and one has to be careful on how you play it out. But for the short to medium term, yes, I think the steel players are in for a good run. Also, you will see a lot of credit upgrades coming, for some of these names, which could also give you a bit of a fillip to the stock price.
Now I want to ask Gurmeet about some dividend plays as well, but just before we do that, 8 minutes have settled or just about settling down. FinServ continues to grind lower. Bajaj FinServ at 5750 is down about 2.25%. So after hitting fresh highs, this one has been on a bit of a pullback mode. Actually, some of the other insurers too, HDFC Life, for example, hit those 535, 540 odd levels and then has come off to 490. ICICI Pru after those very good quarterly numbers and went up to 445 odd. ICICI Pru too has come back to 416. So there's some bit of a course correction that has happened into some of these names. At the broader end of the spectrum, Vakrangi has shown a bit of an uptick the last couple of days. No idea whatsoever. Some buying, etc. seen, but just be very, very careful with the stock of this nature. But that aside, we don't see too many gainers today. Losers include a Quality, a Rain Industries, a Radico Khaitan, a Balrampur Chini, and some of the others. Ruchit, what about Bajaj Finserv? It's not a trading stock, but are there some technical parameters which suggest what levels could it go down to if you believe it will go down in the first place?
I think, Neeraj, the stock has clearly been one of the outperformers since last few months, and if we see the structure, then it is clearly a high top, high bottom structure. Generally, whenever such structures are formed, any kind of dips that comes, that should be used as a buying opportunity for traders as well as investors. I think on the lower side, 5,750 to 5,700 range, that now would be a very crucial support for the stock. So I think this decline, if any, around 57 towards 5,700, that should be used as a buying opportunity. 5,570 could be kept as a stop loss for positional traders.
Okay, Bajaj Finserv was down even on Friday, so let's see whether there is that selling pressure which continues, but the pre-opening rate is definitely indicating that. What did well on Friday was KPIT Technologies, which touched its fresh 52-week high. Amit, on the charts, it closed somewhere about 288, and it's indicating a positive start even in the pre-opening session. What's the view here? What sort of upside that one can expect now from these current levels?
Well, I think the stock is into an extremely overbought zone. So the stop loss for your long position would be at 273. If that gets broken, probably that will give you an indicator that short-term downtrend has started. Now on the upside, if you extend the Fibonacci retracements, they provide you a near-term resistance of around 293. If that gets broken, probably you can expect levels of 310. So 293, I expect the stock to move some more sideways from that levels and then move up. But 293, I don't think so. It's very easy to break in the near term.
Okay. Gentlemen, stay on. So much more to talk about. Minutes away from market open. Let's tell you all that you need to know to stay ahead in trade today. HDFC Bank in focus as the FI investment limit for 4.3 crore shares opens up.
Coal India misses target for both production and offtake for the month of May.
Idea Cellular seeks shareholders' approval to change name to Vodafone Idea. This news hints at completion of the merger.
Dr. Reddy's gets a breather. The pharma company says US FDA has completed inspection at its Srikakulam plant with no observations.
In bulk deals, Baron Emerging Markets Fund bought 0.7% stake in Vakangi on Friday.
And from the auto pack, Hero MotoCorp sales rise 11% in May to 7 lakh units from 6.33 lakh last year.
Okay, Gurmeet, just one thought. I mean, a lot of people believe that FY19 could well be the year of companies giving a lot of dividends and buyback because the free cash flow for a bunch of companies is improving, and you don't see too much of capex lined up for corporate India. Yeah. Are you parking yourself in themes like these, and if so, what looks like a good bet?
I think Neeraj, I think high dividend yielding stock has also always been a favorite amongst the HNIs. I think what has been a bit of a dampener was the budget, where more than 10 lakh dividend income then became part of your overall taxable income. So I think there is obviously a charm in having some of these dividend yielding stocks. I think one stock which could look promising from a dividend yield perspective is ITC. And I think which again is a consumption play. I think the biggest business, which is the tobacco, has been spared marginally or relatively in terms of the higher duties being imposed year on year. And I think it is also a very, very good rural play with their distribution reach. So I think ITC would be one stock, considering even the current price at which it is, vis-a-vis some of the other names which we discussed, including the Nestle's and Levers and Gillis of the world, relatively looks reasonably valued as well. This is all relative in FMCG space right now.
Well, you really can't compare ITC to HUL, but still a lot of brokerages continue to mention that it is trading at a deep discount when you compare it to HUL. The discount is nearly 30 to 35%, but still we've not seen that upside coming in for ITC. Maybe FY19 could be the year for that. All right, 2 minutes to go for markets to open. Let's get you the top trading call from our technical experts. Ruchit, looking at the pre-opening rates, what is your top call for the day?
I would stick with the large cap names, and Maruti, which we had also discussed. I think even for intraday, the stock continues to be a buy. One can buy for intraday with stop below 8730 and expect target around 8980 in intraday trade. Another stock that I would discuss on is Radico Khaitan. Well, probably, recently we have been quite bullish since last few months, but the way the reversal pattern has been formed on the weekly charts, we believe that that it's good time for investors as well as traders to book out profits and come out of this stock. I think the stock is poised to fall on at least 10 to 15% from current levels in short term. So one should look to exit Radico Khaitan for any investment or as well as a trading perspective.
Okay, sell on Radico and buy on Maruti. Amit, what about you?
Well, I would be buying Kotak Bank on the pre-opening. We believe 1270 is a very strong support. Right now, the stock is projecting target of around 1400. So I would buy with a stop of 21270 from 2 to 3 days perspective.
Amit, would you take any call on the bank Nifty while the market opens today? Would you take any position or wait for the opening, considering HDFC is likely to open higher?
Well, we believe Bank Nifty is now positioned for a target of 27,800. So what strategy what we have given is buying 26,800 call option with 28 June expiry and simultaneously selling 27,300 call option. Now this strategy, the net premium we have to pay would be 179. We need to keep a stop loss of around 70, and we are expecting this spread to go towards 400 in next 5 to 6 trading sessions.
Well, that's interesting. That's a bullish voice, 27,800. Typically, if the Nifty Bank were to move up to those levels, difficult to envisage the Nifty correcting meaningfully. There were some calls of buying put options on the Nifty in Friday's session, and which is why I'm referring to this. The Nifty Bank looks like starting off on a very, very good note. Gentlemen, stay on. We'll just take some final thoughts from you post-market open as well. But here's what the markets are going to do, or how they have started off today with a bit of a bang, really. 1.12% of the Nifty Bank could start the Nifty and the Sensex to about 0.6, 0.7%. A few percentage points here and there, but that won't matter. Essentially, it's a strong start that we're seeing. I doubt that the mid caps and the small caps will be doing too much different. Starting off in the green, which is actually a good sign. In Friday, there was a bit of a pull back into the mid caps and the small cap space. In today's session, not showing too much of nervousness, starting off on a small with a small bit of green, but a fair bit of green on the screen. Don't need to dissect too much about the losers, really. Hardly any losers worth talking about. Just look at the quantum of green on the screen. Just gives you a sense of how the mood at the start of the trading day is positive. This is the big week of the RBI policy as well. But no dampening there. IndianOpen Bank, interestingly, is the top gainer, up about 2%. HDFC Bank just about 1.5% or 1.25%, really. HDFC Bank has quickly fallen by the wayside in terms of the top gainers. DRL, no observations, up about 2%. Tata Motors, maybe finding some value at the levels that it is trading at, about 1.5%, but let's wait and watch. Too early to call. Essentially, fair bit of green, hardly any red, no big losers. Let's just focus on individual pockets. 2 or 3 specific pockets that I want to focus on before I hand it over to Navneet. And start off with sugar, if we can. The sugar companies, the prices are substantially off the lows, almost 10% off lows. However, it fails to elicit any kind of response on the sugar names. The market just doesn't like this pocket. What the market liked, though, in Friday's session were a couple of stocks which hit fresh highs, fresh life highs, really. Both Nestle as well as Godrej Consumer, 9986, just tantalizingly away from the 10,000 mark is Nestle. Let's wait and watch. What the markets didn't like, and maybe liking today, were 1% beverages in Atlanta. Both the stocks start off on a positive footing, so that's good going, really, for 1% beverages in particular. But look at quality, that's being decimated, another 8% down at 37 odd points. So chalk and cheese, really, the behavior from some of the top losers in Friday's session. Navneet, what are you spotting?
Neeraj, it's a positive start for the broader market indices as well. But if you look at the sectoral indices, I guess the Nifty Private Banking Index is the top sectoral gainer as we speak. And the reasons for the same are the gains that one has seen for IndianOpen Bank and also HDFC Bank. So watch out for this space in today's trading session. Besides that, Neeraj has already mentioned something like quality, which was locked in lower circuit of 10% on Friday, has seen cuts of another 7 to 7.5%. I remember Ruchit giving a sell call on Radico Khaitan, and that stock's open with cuts of almost 5%. Rain Industries, which is gone for additional surveillance from BSE's side, that too is down almost 4.5%. CG Power, remember that's in the F&O space as well. It's been weak in the last two trading sessions. CG Power this morning has seen further cuts of almost 3%. No respite for sugar companies besides some uptick seen for the prices. Balrampur Chini, the only company which is there in the F&O market as well, is down 3%. V-Guard continues to remain weak after its earnings. We've seen huge correction coming in for V-Guard, and also pull up Cummins. Remember there was an analyst meet. Darshan also highlighted that the stock is corrected almost 40% from its top. No respite there, 1.5% lower. I want to pull up Canfin Homes on back of that news. The stock was down 3%, but the board has approved raising 6,000 crore via bonds and 1,000 via rights issue. So that's opening with gains of 1.5%. Pull up Idea Cellular, which has sought shareholders' approval to change name and also raise up to 15,000 crore through non-convertible securities. No major gains seen there for that one. But Zydus Cadila, besides Dr. Reddy's from the pharma pack, also got US FDA approval for one of its capsule. No major gains seen for Cadila Healthcare as well. Just one more stock I want to pull up, Shankara Building, which was down almost 9% on Friday. It's down another 5% in today's trading session.
Wow. I missed that stock, but yeah, big cuts there on both of those. Opening thoughts from our experts, maybe a stock-specific call to Ruchit, to you first. Anything that you're doing on the indices? The Nifty Bank has cooled off a little bit, as have the key indices too. But opening thoughts on trade on the indices, and if there is any specific stock that catches your eye, or a view on Dr. Reddy's, which is the top gainer.
I think the Bank Nifty has already opened too higher to take a trade now. If any kind of decline comes in and we get it around its previous disclose, then one can look to buy this index. But clearly, Neeraj, one thing that I'm observing, that the Nifty mid-cap index, although has opened positive, but we are not witnessing any follow-up momentum so far post-opening. So I think traders should clearly stay away from the mid-cap from a short-term trading perspective and not do any kind of bottom fishing here. Key is the large-cap names. They would continue to show some outperformance. HDFC Limited would be one of the stock that could be bought. It had given up a good closing in Friday's session, and even today the opening is quite as of now opening looks quite positive. So I would advise to stick with the large caps and avoid the mid-cap names.
Okay, Amit, very quickly, your opening thoughts.
Well, I would say one interesting fact we are saying is, if you see the spread between Nifty 50 to Nifty 500, now that spread has widened from 1250 to all the way 1440. Now this spread indicates that money from the mid cap is now flowing to large caps. So now this will force most of the fund managers to reshuffle their mid cap portfolio and shift to large cap, and that will help Nifty to move higher. Now from a sector perspective, we think commodity is one sector which we believe has seen a good amount of selling in last 2-3 months. Now this sector we are expecting a sharp run up in the near term. Within that, we think Vedanta is one stock which has seen a good bottom build up around 245, 246. So I would say buying that stock from a 2 to 3 days perspective would give you a target somewhere around 261 to 262. Stop loss for your long trade would be at around 240.
Okay, gentlemen, Amit, Ruchit, as well as Gurmeet, all of you, many thanks for joining in today and giving us your thoughts. Really appreciate your time this morning, and have a great week ahead. Well, let's get a very special guest on the show. Manish Sonthalia is head of equities for portfolio management services at Motilal Oswal Asset Management Company. Joins us right now on the show with his thoughts. Manish, really appreciate you taking the time out. Good morning. Thanks so much for joining in. You know, if we juxtapose what's happening in the macros versus the micros, there's a bit of a dichotomy here. However, I just thought, Manish, that last week or the last 2 weeks, we've got a couple of fairly decent ticks on the macro front as well. While albeit lower than expected, but the GST collections did seem like a number which is on the mend. The GDP numbers looked fairly strong as well. How does all of this portend for what the markets do over the course of the next 12 months?
So starting with the numbers, you know, the quarterly numbers that just went by, on the quarter that just went by, were decent enough. I don't think there was any major disappointment except for, you know, the corporate banks. Of course, there was disappointment. It was expected to be disappointing. But if you leave aside the corporate BFSI space, I mean, I believe that the numbers were perfectly okay, and there's going to be a build-up on the profits as we move into 2019 numbers. So that's taken care of. I think in terms of macros, only the oil price and the rupee would matter at this given point in time. I would believe that GST numbers, which was something like 5,000 crores or short than the previous month was okay. I mean, there's not too much to worry about on that front. As well as the GDP tick was higher, so that was a positive surprise. I think the key point to note out here is that if oil moves to $70, we could see the Nifty cross 12,000. And because that's going to have a rub-off impact on the rupee, and the rupee being now at closer to 69, there's not too much of a room to fall further from these levels. And this would attract FII flows, try to invest in Indian markets where there has been some decent correction, at least in the larger, broader market per se. So I would look at the markets more positively at this given point in time for a couple of reasons. Oil has come off its highs. Rupee has depreciated significantly. I don't think there's too much of depreciation possible from these levels. And, put these things together, it's a perfect recipe that, I think the market should be positive from these levels.
Hi Manish, good morning. Well, clearly the focus remains on the macro with regard to the crude prices, or for that matter the movement in rupee. At least the last few days have been good on both these parameters. But this week now the focus also shifts to RBI meet, which is lined up for June 6. What are you watching out? Do you expect any sort of rate hike in this meeting, or you expect the rate hike to come in the month of August?
So I think the monsoon season should be watched out for. I don't think there is too much of a possibility of a rate hike just yet. Maybe we'll have a status quo even day after tomorrow. But given how Kharif plays out, the Kharif season plays out, we'll broadly be taking a call on the rates sometime in August. I think over the next 12 months, 50 bips or thereabouts should be what should be built in. I think the markets are already factoring in a 50 bips rise from these levels over the course of next 12 months. Whether it happens tomorrow or August, we need to figure out. But I think there is more a chance of a status quo rather than a hike per se. But even if a hike is about 25 basis points, it should be okay. I don't think markets should be very negatively surprised even if it comes through, because there has been some decent correction in markets, and most of the negatives that are there prevalent today would have got priced in.
Manish, if I were to look at the correction that one has seen in 2018, well, the large caps are still where we started this year at. The major correction that has come in has been in the broader markets, and as we speak, it's the broader markets are finding it very difficult to remain in that positive territory. Mid cap as well as small cap index has once again slipped into the red territory. Do you think this could be the year of large caps and not the mid caps? And if you're not of that view, do you think there is value in mid caps after the correction that we've seen?
Yeah, so there's no doubt that there's value in mid caps today as opposed to what it was, let's say, a year back or 2 years back. See, we need to understand the thing in perspective. Post demonetization, GST, a lot of money has come into the mid cap and the small cap, right? And due to the reclassification on SEBI's part, what was a large cap has become a mid cap. Based on the reclassification, what was a mid cap has become a small cap. Now you have a lot of money which has come into the mid and small caps, and you are supposed to adjust all your funds within a cutoff date, and that is actually exaggerating the fall in many of the mid cap and the small cap names. Of course, there has been a PE multiple contraction due to deteriorating macros, etc. But 60% of the mid cap stocks have lost more than 20%. I mean, this sort of a thing was really, I don't think that the numbers are that bad as far as the quarterly numbers per se are concerned. There's been some correction on PE multiples, but most of the thing has been due to technical factors like reclassification of the categories, the large caps, the mid caps, and the small caps. So,
okay, sorry, you are making your point, finishing your point, Manish?
Yeah, so once we get off this cutoff date, whatever that cutoff date is, 30th of June or thereabouts, you'll see a reversion back to mean. So much of money is actually flowing to the large caps that you'll create excesses on the large caps. So from that point of view, you'll see some decent correction in the large caps once the cutoff date passes. And then when you have created so much of a vacuum in the mid cap and the small cap space, again you'll see a reversion to the mean. Now that you would not see too much of selling coming due to technical factors. Of course, fundamentals will determine the course of the mid and small caps in any case, but you won't see too much of a selling coming in through technical factors. I mean, that again is quite evident to happen once that cutoff date gets over. So whatever that cutoff date is, we'll see reversion to the mean on both the large cap and the mid and the small cap space.
Manish, the last time that we spoke on Alpha Moguls, you were fairly constructive or hopeful of this move from the unorganized to the organized, primarily due to GST. Now, a few managements that we spoke to, Manish, in Q4 seem to suggest that the parallel market is not only existing but thriving. The whole move hasn't happened at the pace that people anticipated, and we're hoping that the e-way bill probably could do the trick as well. Have you personally been disappointed with the swiftness in which this would have happened, or were your estimates of a slow, gradual shift, and therefore the shift is happening as per how you anticipated?
No, it is happening. Now, there are two things to this. See, the GST rate on many of the consumption names have come down from 28 to 18%. So you would have seen many of the consumption names has actually seen a volume uptick. Now, you could say that, part of this uptick was due to GST, but there's also a second reason, given the fact that, there's price elasticity on demand, and 28% coming down to 18% would have triggered some sort of a volume uptick. So, the last quarter, which is the fourth quarter, and the first quarter would see a very low base effect when we compare it on a YOY basis. So this quarter again you're going to see some very decent numbers in terms of a volume uptick, but part of this could be due to the fact that GST rates on many of the consumption names have come down. So there is a volume uptick due to price elasticity and demand. The real test on whether there is a shift from unorganized to organized is going to be felt from the third quarter onwards. So first two quarters till about September, you're going to see volume uptick, but that could be attributed to price elasticity and demand. The fourth quarter, the third quarter and the fourth quarter is where the real test would be. My sense is, doing some ground checks, that it's happening. The shift from unorganized to organized is happening, albeit at a very slow pace. And now that e-way bill has also kicked in, we need to see how effective this whole pickup in the shift would happen. And of course, GST numbers on a monthly basis would also substantiate whether the shift is actually happening or not. So it's a wait and watch. I wouldn't rule out that nothing has happened in the quarter gone by. There is movement, there is a shift which is happening, although very slowly and may not be noticeable immediately, but things are playing out as expected.
The standout for me, Manish, in that conversation was also about the possibilities of, or why is it that the markets would be wary of the kind of volume growth numbers that these companies have shown. You've explained it in part about how the prices coming off led to the volume growth numbers as well. But do you believe there is a prolonged period of, may not be 15%, but a prolonged period of fairly decent volume growth numbers that we are in for the FMCG space by and large?
110%. First of all, an inflationary environment works best for staples, the FMCG companies, because not only volume growth, you also tend to take price increase, and part of which flows into your EBITDA and your PAT. And second, we are coming off a very low base. Last 3 years, broadly, the FMCG space, barring a few exceptions here and there, have not done anything because it was all about volume growth. There was hardly any pricing power. One needs to see whether the raw material cost increase gets mitigated through price increase, and that would actually show what sort of a pricing power these individual companies have. Valuations have corrected, volume growth is here to come, shift from unorganized to organized is happening. It's in a sweet spot. The consumer staple space remain the favorites for the next 1 year.
Okay, in fact, the earnings from this space definitely did not disappoint, this time around for the fourth quarter. Pull up HDFC Bank. Remember, that's the stock which is in focus. It's now in the red, and let's not forget, it gained nearly 5% last week, and now as we speak, HDFC Bank is down 1.5%. Manish, a word on the banking space. How should one play this? Private versus PSU, is there any value that you're finding in the PSU banking pack, considering the sort of correction that one has seen? And also a word on the Mint report today, which suggests that government is considering merger of banks like Bank of Baroda, IDBI Bank, Oriental Bank and Central Bank. Do you think consolidation is the way forward for the PSU banking pack?
So I think it's private sector banks all along. There's no, I mean, one needs to be a brave heart to actually look into these PSU names. I mean, there is no doubt that there is value, but the whole space is having so many problems. It would require too much of courage to actually build in position at these levels. I think I would wait for some more time to get clarity when the NPA cycle would have actually peaked, and then maybe take a call on the space. Till then, it is about MFI, which is going to be in a sweet spot. The NPA levels are coming down significantly. It's an election year, so the rural space would be doing good. The private sector banking space, there is a shift away from the PSU banks to the private sector banks, NBFCs. And here I would focus more on the retail lenders as opposed to the corporate lenders. Coming to consolidation, I think government is of the opinion that we should have large PSU banks as opposed to too many PSU banks. And the merger that is being thought about in terms of Bank of Baroda taking over or merging 3 more PSU banks would be a step in that direction. Of course, it would come with its own set of challenges, the worker strength or the labor strength out there, the cost is to income ratio, the capital adequacy, because the names that are being touted to get merged in, let's say, Bank of Baroda don't have a very happy picture as far as the balance sheet is concerned. So there would be challenges, and I think the full brunt of it will have to be taken by Bank of Baroda on its balance sheet. So once this new entity emerges, then there would be clarity on how the growth and the NPA levels would play out. But till about the time these banks get merged into BOB, I think there will be some more haircuts that needs to be taken on this front.
All right, Manish, we'll leave it at that note. Appreciate you joining us this Monday morning and taking us through your views on the markets. Well, the markets as we speak have given up the opening gains. The Nifty Bank is now in the red. Mind you, the gains were being led by the likes of HDFC Bank and also Indices Bank. So Nifty Bank almost at 26,670. Nifty is also just about holding up with gains of 15 points. Quickly before I wrap, I just want to address few stock. Pull up Capital first. That's the one which is seeing some strong gains in the opening session. And well, on the losing side, you've got something like Delta Corp and Shankara Building, which have come under selling pressure this Monday morning. Delta Corp is down 5%, and Shankara Building, after seeing cuts of almost 9% on Friday, is down another 8% in today's session. Well, on that note, we'll wrap it up here, but don't go anywhere. On the other side of this break, we discuss corporate earnings with Suhas Harinarayanan of GM Financial. Stay tuned for that.
Sir, please believe me, I am in this business for the last 12 years. Okay, I'll wait for your call. Thank you so much.
They still don't know you after all these years?
क्या करें? पहचान ही नहीं है.
Simple solution है. List on the stock exchange. With listing comes recognition. Investors get interested in you. And funding happens.
Come on, yaar. I'm not big enough to list. Chal, let's leave.
There's a stock exchange exclusively for your kind of company. NSE Merge. It's the right platform for your business.
Really?
Yeah.
My kind of company?
Exactly. Get listed, get recognized. अरे भाई, हीरे की असली परख जौहरी को ही तो होती है. चल.
NSE Merge. साथ हमारा, सफलता आपकी. The SME Growth Platform from India's largest stock exchange.
RP Sanjeev Goenka Group, growing legacies.
Catching up on news feels like a test match. Want the highlights? We hear you.
It's an ocean of news out there. Need a navigator? We hear you. do you have analysis paralysis, a case of too much information and not enough time? Do you wish someone would just pick the most relevant topics and tell you what you need to know? We hear you.
Good morning. You're watching Bloomberg Quint. This is First Word.
Curated and presented by Bloomberg Quint's senior-most editors. Weekdays at 8 a.m.
Welcome back. You're watching Indian Open right here on Bloomberg Quint. The fourth quarter's turned out to be, well, if you look at the Nifty 50 as we analyzed today, better than average quarter for India Inc., with certain sectors like cement and construction posting healthy growth in the first 3 months of 2018. What's also encouraging is the healthy guidance numbers given out by certain specific firms. But if you look at the broad-based numbers, Q4 ended up resulting in FY18 not having a double-digit growth. The question mark only is, does that give us a base which could catapult the earnings to a 20% odd optimism that everybody is working with? Let's try and find out if Suhas Harinarayanan believes that that number could turn about. He's the head of institutional equity research at Jain Financial Institutional Securities. Typically tends to join us for these earnings conversations once every 6 months. Suhas, good having you. Thanks so much for taking the time out. And happy with what Q4 was, or were you disappointed?
Yeah, I think just as in every quarter, I think one has to do a lot of chops and splits and then try to analyze the numbers. Headline numbers, definitely bad, because when we looked at one particular parameter we look at is beats to misses ratios. See, while there is a Nifty 50, we have a broader coverage of about 155, 160 stocks. And if you were to just look at the 155 stocks, how many stocks are beaten versus how many stocks are missed? If you do that kind of a ratio, this has probably been one of the worst since 2Q FY17 if you ignore the pre-GST quarter, right? So to that extent, this has not been a great quarter. And if you look at headline numbers, there's been a decline in profits, right? Whether it's Nifty 50 or the broader universe that we look at. So which is why I said I think there are, one needs to, look at the numbers after splitting and chopping. So I think there are basically 4 numbers. As I said, the headline numbers don't look great. The beats to misses ratio is probably one of the worst. One is revenues have beaten expectations. Revenues have beaten handsomely, in fact. Margins, though, have been a steep disappointment. Thirdly, this quarter just had too many one-offs. Even if you exclude the bank write-downs, if you include the bank write-downs and the adjust for the one-offs, probably the numbers have actually beaten. But then you'll have to believe that the one-offs are one-offs, right? Maybe they don't come back, but you have to believe that the bank write-downs don't come back again. If you believe that, bank write-downs are also, this is probably one of the last few, maybe 1 or 2 other quarters more, then you could actually end up with the kind of, the 20% number that the market and the street is looking at for FY19. So as I said, this is particularly, headline numbers have not been great at the profit level.
Do you believe that these are one-offs for the banking space as well?
Difficult to say, but I think I would tend to go with the general view that possibly we are closer to the bottom than we've clearly crossed the middle, and we're probably closer to the bottom than we were in the last probably 2 years.
But why do you believe that? I mean, is it because the corporate commentary on con calls sounded a lot more believable than what it has been? Because the common question that almost every PSU bank manager has been asked thus far, I mean, to Jay Kumar of Bank of Baroda as well, right? That for the last 2 years, you've been saying that we're very close to the pain points getting over. Somehow it hasn't happened. And every quarter, I remember at least one report saying that, yes, the worst is behind us. Somehow it doesn't turn out to be the case. So what gives you the confidence this time around?
No, I think it's also the, if you look at the NPA profile across sectors, I think, we're probably largely behind the curve, or I would say, or the steel we're largely behind the issues on the metals and mining sector.
Sure.
I think the big exposure that people were looking at were on the power sector. And we've done our work on the power sector. there's probably a little bit more, but if you look at the power NPAs as a percentage of the loans outstanding on the power sector, I would think anywhere from 30 to 50% of the power exposure have already been recognized as NPAs. Right? These are, I'm talking of the non-PSU loans. Because I would say non-PSU includes maybe loans to even some of the powerful, the PSU financing companies as well. So if you exclude that and just look at private sector loans, then I would, our view is that anywhere from 30 to 50% of the loans exposed to those sectors have been recognized as NPAs. Right? So that gives us clearly much bigger confidence. Now, whether there's another 20%, 10%, but clearly, we're almost crossing the midpoint of the exposure on the segment. So that was a big problem sector as we analyzed. So as I said, metals we are probably largely behind. Power we are slowly leaving it behind us. Now I don't know if any other sector comes up and creates a problem, but as it stands now, I would think or our view is that maybe 1 quarter more and we are probably done with a large part of recognition of the issues in the sector.
Interesting. Okay, so then in which case, what's the earnings outlook for banks? Let's talk about that because that's the biggest one, right? Based on what you've seen in FY18 and the kind of base formation that happens, though I think the base has virtually stayed okay for private banks. Yeah. How does FY19 come about?
No, I think if you leave out the, talk about the retail financials, I think, probably steady, right? The corporate banks, we are expecting obviously a big rebound in FY19. In fact, a bigger rebound in FY20, right? So I think there's no reason not to believe those numbers at this point in time. So we would, so in fact, if I look at that, as I said, the consensus earnings expectations of 15 to 20%, or I would see even numbers are extending to 23% YOY growth for FY19. The biggest drivers are your banks, your metals and oil and gas.
Okay. So that's as far as banks go. I'm just extending this. Yeah, NBFCs, you believe this whole talk of the rising rates, etc., and that certainly seems to be a given in this year, maybe even the next one. NBFC's cost of borrowing could go up. Could the Goldilocks scenario of sorts come to a bit of pause, or do you believe the lending cycle is strong enough for them to continue making the money?
So this has been one of our most overweight sectors for the last 4 years, I guess, for a large part of the street as well. And I remember at the beginning of the year, these worries had come back, because you were looking at a rate increase scenario globally, not just in India. We stuck to the theme, basically saying that, the volume growth in the sector will be so good that, that will take care of the increase in costs as well. We're continuing to stick with that thesis.
Okay. How did you analyze the earnings of let's say autos? Let's start off with that. High frequency indicators of sorts. The numbers looked okay. The earnings, at least what we tried to analyze in the morning, seemed to suggest that a bunch of companies had some issues, real issues this time around in the earnings delivery. Were you of the same opinion? And what would your thesis be for earnings growth in FY19?
No, I don't think we had particularly had any issues on the auto sector. I think they were
Tata, JLR, Eicher, etc. No.
So I don't want to get into company specifics, but I think broadly, except for the first company you mentioned, where I think we try to always take it out of the earnings discussion because there are a few one-offs from time to time. But I think broadly the auto sector, I don't think there were any particular issues with respect to auto sector. I think we were expecting about if you exclude the company, we're expecting about 20% YOY growth. It's come at about 19% YOY growth on profits. So clearly no big issues in the auto sector.
At the moment, the juggernaut continues, you think?
Yeah, so I think for the time being, yes. I think one will have to watch the CV cycle a little more closely because there have been other drivers for the CV cycle because they were coming off a very low base for about 6 to 7 months, and then you had this overloading ban issue, helping CV volumes in certain large states in the north. That's probably one cycle to track, but even there, our belief is that the replacement cycle will help sustain a double-digit growth in FY19 as compared to last year. While the base begins to look unfavorable from August onwards, I think the replacement demand should be pretty strong. So we are still sticking to our large bets on the auto sector.
Okay, interesting. What surprised you the most? I have a couple of other spaces that I want to talk to about, but anything that surprised you this time around, positively or negatively?
I think positive surprise is clearly on the consumer profits, largely led by a very sharp expansion in margins.
Okay, so this is in contrast to the overall earnings season, right?
Yes.
Because you started off saying that margins,
correct,
by and large, came off.
Yeah, correct. Yeah, good point. I think, so this was one area where we actually saw, good margin expansion. Not completely unexpected, but some of the companies actually beat our expectations on margins as well. While the overall revenue growth were largely in line, but I think the margin growth clearly was a surprise. And so you actually had a pretty strong beat on the consumer profit number, which is a large sector at the end of the day from a broader India perspective. So if I look at the companies under our coverage, I think the consumers actually profit growth was almost 19% YOY, versus a 15% kind of expectation.
Okay.
So that was clearly a positive surprise, very clearly a positive surprise to us.
How does that set us up for FY19? Because the base obviously won't be low. The volume growth numbers, especially Q3, Q4, picked up well.
Yeah.
Somebody that we were speaking to us just moments before you came in mentioned that technical triggers like the GST rate coming off will probably ensure that volumes anyways stay higher because of the elasticity factor. And then you got to see whether the unorganized to organized shift also works favorably. What is that you will be working with?
Yeah, so I think clearly the volume growth led by partly the GST led price cuts. Unorganized to organized is played out in a few sectors, has not played out in a lot of sectors that people were expecting.
Yeah, but staples in particular?
Staples, there's really not much of that unorganized to organized shift as we can see. But I think what will also support staples could be, we are pretty bullish on the rural sector for FY19. I think from that perspective, the volume growth should sustain in our view in FY19 as well.
Okay, so since you started off on that theme, let me ask you, how was maybe not just the last quarter, but the last 2 or 3 quarters, rural is probably a theme that stretches out.
Yeah.
How was the last year for rural, and what is your preferred mode of playing the rural space in FY19 from an earnings perspective and then maybe a valuation perspective?
Yeah, so I think rural numbers were pretty strong on the discretionary financials and also on the staples, right? Our preferred mode for FY19 will still be if you were to build a rural portfolio, I think I would give a larger weight to discretionary and financials and then to staples.
Okay. There was, how do I say, some bit of mismatch or, some bit of variance that we saw in what the expectations were versus what the delivery was on a lot of these consumer durables, right? But air coolers, for example, got decimated because of weather concerns. Similarly for air conditioner segments as well, select pockets didn't do well. Consumer durables, at least the listed space, what do you believe? Because again, the whole unorganized to organized hasn't quite helped them meaningfully in the second half of FY18. So therefore, the base is not as unfavorable as what would have been. How did you analyze the numbers? What is your expectations for FY19? It's not a very large pocket, I know, but still.
No, I think so. Consumer durables ex autos, right? So I think clearly within that, electricals seem to have held up and have reported reasonably strong numbers. A lot of the others, when you look at the tiles and plywood, etc., I think they have been massive disappointments. I think in that possibly that unorganized to organized shift, plus what is also essentially a weak real estate market is probably not helping. One big driver that we saw for electricity, it's a theme that you should probably run a special series on at some point in time, is clearly on how the increased power availability in in UP, Bihar, etc., are driving sales of electricals. Because if you look at last 3 years, the CAGR for electricity consumption growth in UP and Bihar have been double digit growth. If you include MP also, it's still double digit. Well, if you look at the all India number, excluding these three, it's probably 3 to 4% CAGR.
Interesting.
Right? So I think when we went around, we have a series called Rural Safari, right? So when we went around,
I love those reports, by the way.
Yeah. So when we went around doing that, we actually saw, the gentleman who does this more regularly happens to be from Bihar, and he was telling us that you actually started seeing induction cooktops in rural Bihar, right? That's largely because of the availability of electricity. You probably always had a wire going through, but you now have, electricity for 18 hours and, 20 hours. So that's actually a, big theme which we are driving. So, and it's also reflected in the numbers which have come through on the electricals. So the electricals consumer durable companies have actually reported strong numbers.
Interesting. That's very, very interesting. Yeah. Okay. Any other such nuggets?
We'll talk about it in detail later.
Okay, maybe later on. Paucity of time, but let's talk about a couple of pockets here. We haven't talked to you about cement at all. What did you make of the quarter? And how does FY19, FY20 look like? Some of your peers are factoring in that FY20 will be that year of big meaningful growth in cement volumes. What are your thoughts?
So I think, before we talk about this quarter itself, specifically on cement, what we've seen over the years, cement always starts with very high expectations, and it's a sector which have actually consistently seen earnings downgrades every year for the past 3 years. I mean, it's happened in other sectors, banks and otherwise, but those are all NPA led, but cement also we've seen that kind of a number. And secondly, cement stocks always in the last 3 years have also tended to trade at a premium to its history. So on one hand, you had an earnings downgrade, and then you had a valuation which was trading at a premium to history, so which never really helped those stocks. A lot of cement stocks are actually flat when you look at from a 3-year basis, even some of the large cap names, right? So this quarter, incidentally, from a EBITDA level, vis-a-vis expectations, it was not so much of a disappointment. PAT level, there was disappointment, but probably the quantum of disappointment has actually declined this year compared to the previous quarters. Having said that, I think FY19 and 20, again, as you rightly pointed out, in FY20 there is a fairly sharp improvement in profits which the market is expecting. Okay. So we have it in our numbers as well. But our cement analyst had put out a very good report where he had highlighted that the expected pricing power that the sector is looking at as capacity utilization improve, that's probably not going to come out that fast. It's probably going to take time because there's still a lot of capacity being planned and probably coming up in the next 3 years, which will actually continue to put a pressure on cement prices.
Interesting. So, and of course, we can't get down to talking about all the spaces. I know I haven't asked Suhas about IT at all, but having said that, looking at all the variables that have happened and how Q4 has happened as well, you gave us your base case of what you expect the earnings growth numbers to look like for FY19. Do you believe the recovery in earnings, if I can use recovery as a term loosely, will it happen, would it be back-ended, or would you believe there would be a higher chance of we starting seeing these numbers Q1 onwards itself?
No, as you rightly pointed out, I think banks tend to be a big driver for these earnings growth, right? So the 3 sectors which are expected to drive earnings growth in FY19 are clearly banks, metals, oil and gas. So banks is clearly back-ended. Yeah. So I think that will determine, how the trajectory goes, for the rest of the year, because those tend to be big drivers for the earnings.
Okay. So, and lastly, what's your big earnings bet? I mean, I'm not getting into the valuation bet, and therefore this is not in that space that you are necessarily recommending to your clients. But what's your big earnings bet? What is it that drives the biggest earnings growth? You mentioned banks, metals, and oil and gas. That's the standard expectation. Anything else where you are anti-consensus, wherein you believe that numbers will pick up, even it may be a small space as well?
No. I think as we discussed, I think there are a lot of concerns around NBFCs, housing finance companies, right? I think we continue to be fairly bullish on the NBFCs and private financial space. And I think, as I said, at the beginning of the year, there were a lot more concerns, but we continue to stick to our bullish stance on that space.
Okay. Well, Suhas has left us with a bit of a teaser. Remember, he spoke about this very interesting statistic of power growth in UP, Bihar and some of the others versus the rest of the country over the last 3 years. But it also leaves us a teaser with some more interesting discussions with him, possibly over the course of the next couple of months as well. So we look forward to that. And we are out of time completely on this show. Suhas, thank you so much for taking the time out and being with us on this earnings conversation. Really good having you.
Thank you.
And viewers, thanks for tuning in. Keep in mind, the Nifty Bank, all of them have come off quite substantially from the levels that they were trading at. So a bit of a red on the screen. Nothing to worry though. The FNO show will take forward the action on the other side and try and dissect some of these individual parameters. Thanks so much for watching today's Indian Open.